Good afternoon, friends, clients, and fellow financial advisors. My name is Ron Bullis, and I'm the CEO and founder of Lifeworks Advisors. Thank you for joining us on our year-end market update webinar. Joining me today is Alex Mathekathala, our VP of Investment Strategy. Alex, how are you doing?
Doing great. How about you?
Couldn't be better. It's actually like 50 plus degrees in Michigan right now, and the sun is out, which seems to be a miracle. And what a fine day to be having a year-end client market update when there's not snow on the ground like there normally would be. So, Alex, I know you have a lot of material you're going to be covering today. I'll be jumping in with some questions. For those of you watching online and live streaming, just to the right of the video on the screen, you should see a box that says Ask the Presenter a Question. When you type questions in there, we'll actually be able to see them in real time. Alex and I will do our best to pause the presentation or kind of hold those for a little while and get to all the questions before we're done today. As always, we are grateful to have the opportunity to serve you and your families, and we are excited to share some of the news and the things that our investment team and our advisors talk about regularly, have been following and thinking about, and some of the interesting news items from the last couple of weeks. So, Alex, with that, I'm going to kick it over to you, and I know we've got a long presentation with some good stuff in it, so kick it off and let's get rolling.
Awesome. So let's jump right into it, to page 3. We spoke quite recently, so we had a market update 4 weeks ago. So this presentation is going to focus mostly on what was news since then, since mid-November. And actually, the biggest news out there was the Omicron variant from South Africa. So that happened the day after Thanksgiving in the US. American people woke up to this news, and it was the most dramatic, let's say, risk-off day in almost a year. So you see on this slide a plot that shows a ratio between a proxy for risky stocks, which is SPY, an ETF for S&P 500, and a proxy for safer assets, which is TLT, an ETF for longer-term government bonds. And what happened on that Friday 3 weeks ago was that we had this sharpest move down, so minus 5%. So it was really like the return to this old financial crisis paradigm where you have this risk on and risk off type of swings, where assets really move according to the perception of whether we are in a safer or a riskier environment. This was really the biggest news since the last time we spoke. Well, since then there has been more details from specialists on this variant. Allegedly, it's more contagious than the previous ones, but much less dangerous, much less deadly. I will emphasize again on the word allegedly. So you had some kind of reversal in that risk on risk off trend lately, and people went back to the risk on mode. And the second most important item will be inflation. So we maybe sound like we're rambling a lot, but that's really the major topic of the year. 2021 was all about inflation, and so that's the case again. We had in November, well, we had the news in December, but the number came for November, and they came last week. And so in November, we had yet another acceleration of inflation for consumers, about 0.8%. October was already 0.9%. So if you move to slide 6, the next slide, you will realize that this number brought the year-on-year number, so that is the 12-month inflation, to a record high, 6.8%. This is actually a record in almost 40 years. So since June 1982. So that was really shocking again for all market participants and especially central bankers. We can also look at the most recent news, which was delivered 2 days ago on Tuesday. If you go to page 7, and keep in mind that the Fed Open Market Committee, so that is the most important deciders at the Fed met yesterday and 2 days ago, having this slide in mind, having this latest piece of data in mind, and we'll talk later about their decision. But first, about this data. So this is producer price index. So inflation for producers of goods. We have here finished goods, and the numbers came in very hot on Tuesday at about 13%. So that is yet another unpleasant surprise, very elevated. And that's actually the most elevated, the highest since 1979.
Alex,
Yep,
if I could interject just a quick question here. There might be some people watching that are wondering what's the interplay or the relationship between CPI, consumer price index inflation, and the producer price inflation. Can you just explain a little bit about how those two have an interplay and also why they're different?
absolutely. So the most widely used proxy for inflation is CPI. So that stands for Consumer Price Index. So you look at a basket of goods that is estimated to be illustrative of what an urban consumer buys. So when you talk about CPI, you talk about what you run or experiencing as a consumer, like the average
Feeding all my kids.
American person. Exactly. When you move to PPI, Producer Price Index, this one, in terms of numbers and correlation, has a lot to do with CPI, but the definition is different. You no longer look at a consumer that is an individual, but you look at a firm, an enterprise, which is producing stuff. So that could be industrial goods, that could be infrastructure, that could be many things. In this case, we look at a much more narrow branch of producer things, which are finished goods. So in this case, you measure the inflation, like how the price of goods produced by companies is evolving through time. But the important
Got it.
thing is, of course, that this producer price index sorts of anticipates or precedes in time the consumer price index, because as a final consumer, you always buy something that has been produced by a company. So the two are very much related. And when the Fed is trying to control prices and make prices for consumers stable, they need to keep that data in mind. And one other thing that you could look at in order to sort of dissect those producer prices is the difference between goods and services. So if you move to the next slide, you will see that you have no, like on Tuesday, we had no consolation in the breakdown of the numbers, because the overall inflation sure has been mostly driven and still by continued excessive demands for goods, because the use of services was really limited due to the pandemic. So you don't go anymore you don't go as much to the hairdressers, you don't go as much on vacation, etc. But while inflation for services was not picking up too much or was not picking up as fast, well, over the past few months, it really started as well. And it's the fastest actually since the whole series for PPI was started in 2012. So this was pretty worrisome. Then you could also dig even deeper and look at how businesses were dealing with this. And if you took this latest National Federation of Independent Business report that was released also on Tuesday, you see that the situation is worrisome indeed. So you can see on this chart two plots. One is dark blue for actual changes in wages, and light blue or sky blue is for plans to change wages. So those reporters, they are asking business owners, small business owners, whether over the past 3 months they had to increase wages or reduce them, and whether over the next few months or quarter they plan to change their compensations. And you realize that like last month you had a record high in the number of businesses that both experienced higher wages and also are planning to increase wages even more in the near future. You from the same survey, you have another question which we dissect on page 10, and the question was the following: did you actually increase your own prices? So beyond wages, what you are producing or what you're selling as services, have you increased your prices? And again, we have a record high, highest since 1979. Another question which is interesting, which we show on page 11, is the following: what is the single most important problem facing your business today? When the reporters asked that question a year ago in January, almost 0% of small businesses would answer inflation. Today, it's
Wow.
almost 17%. So one business in six has inflation as their major pain point today. So it's hard when you look at all of those pages. It's pretty hard to imagine a worse picture than this lot of data for anyone who is concerned that rates, as set by central banks and as modified by commercial banks and set by financial market participants, for anyone that is concerned that those rates do not increase fast enough. Because indeed, as we've seen, there is plenty good reason to raise inflation forecasts. And if you move to the next page, in reality, that's not what we're witnessing. Inflation forecasts are not being raised over the medium term. So here we have the five-year inflation break-even, so-called five-year, which predicts the average level of inflation for the 5 years starting 5 year hence. So from 2026 to 2031, what is going to be the average inflation according to financial markets? Because the way those are calculated is you look at the pricing of inflation protected treasuries and you compare them to non-inflation protected treasuries. And so
Alex,
you look at this chart.
Alex, I want to ask a question here a second, and maybe you're going to get to it, and so I'm jumping ahead and stealing your thunder here. Is it a possibility, or maybe even a high probability, that part of the reason the financial markets haven't priced in a significant change to interest rates is because when you look at those preceding slides about the consumer price index being up year over year at all-time highs, essentially taking us back to the days of Jimmy Carter in the 70s. If you look at the producer price index changes, we don't have one on here. You and I have talked about it, like housing price changes, across the board, goods and services, some of the highest record year-over-year increases in prices, wages that we've seen. Is it possible, or maybe highly probable, that part of the reason the financial markets, in your opinion, haven't started to move interest rates upward is because they're worried that these high inflationary aspects across the board could lead to a downturn in the financial markets, which would lead to people potentially rotating out of equities and moving into safer assets? And obviously, the more people that want to buy something drives the demand up, drives the price up, drives the yield down. Can you talk to us a little bit about whether that's a possible scenario why we haven't seen the financial markets adjusting to these very clear high inflationary indicators that we see?
Yes, definitely. You're completely right. To answer that quickly, I would say this is one of the three main reasons that you could detail to explain why forward inflation has not picked up yet. I'll talk more into this one, but I'll briefly mention the other two. The first one is a so-called base effect. Prices have already gone up by a lot, so we are already at elevated prices. So from that basis, people expect prices not to go again as high in the future. A second explanation is this so-called transitory belief. People very simply think that supply bottlenecks will very soon fade away, and that the economy will return back to normal. And the third reason is exactly what you said now, and I completely I consider your arguments very valid, and a lot of market participants consider them very valid. If I can try to maybe phrase what you said in different terms, because I think that really summarizes very well what people think. They think we still are not, we still haven't left this secular stagnation type of era. To add on to what you said, the US working age population is shrinking for the very first time since World War II. US productivity last quarter shrunk at its fastest pace in more than half a century. When you look at companies' capital expenditures, they are pretty disappointing. And so, as you say, like bottom line is that the supply side may be anything but gangbusters. It's really more reminiscent of a quote unquote secular stagnation paradigm. And so this in turn really prevents the market from aggressively repricing terminal rates, as you said.
Got it.
And so if you move to page 13 very quickly, that's exactly what you see. So this is whether consumers believe that inflation will go up. You realize that in 2020, 2021, the needle was hardly moved, still quite stable at 3%. And if you move to slide 14, here we have a survey asking the very market participants, so fund managers. So indeed, when you look at the transitory column down there, you see that 55% of fund managers in December still think that inflation is transitory, down from 61%, but that's still the majority of them. That's still the majority of them. So very, very valid point.
Yeah. No,
so
thanks
next,
for detailing that. I think that the only time obviously tells, right? But one of the things for everybody listening to keep in mind is that when we look at, whether it's CPI or PPI, these measures of price change, right? They're generally stated as a change on a year-over-year basis, right? So if prices have jumped up, at the fastest rate they have in decades, right? It might be that next year's CPI goes back to maybe an average, rate, which might be 2.5% or 3%, but it's not likely that it's going to deflate, right? And I don't think we're going to get into talking about that on here. So I think this transitory language, at least in my humble opinion, is a little bit misleading across the board, or a little bit, maybe we need to be more nuanced and cautious about it, because I think when you say the word transitory, in my mind, I'm hearing it's something that happened and then it's going to reverse and trend and return to a normal course. And when we're talking about pricing changes, right, Alex, we're talking about things that go up, and then it's likely that they will stay at that price point and continue to climb higher from there at a more normal rate of inflation, or the rate of change of the price will maybe return to normal, and this aggressive acceleration in CPI that they're calling transitory will pass. But I don't think we're looking at a situation. I think when I'm, hearing you talk and looking at, this slide, Alex, I don't think what we're talking about is that fund managers and the markets have an expectation of deflation, correct? They just have an expectation that the rate of price increase won't be as crazy as it's been the last 12 months, correct?
Absolutely correct. They expect it to go down to 250, 240%
Okay,
in 5 years from now. 5 year, yeah.
got it.
And that's broadly the view of central bankers as well, which is what we're going to see now. If you dissect their meetings from yesterday and the day before yesterday and their decisions, they are roughly in line with what you just said, Ron. So yesterday's meeting was much anticipated because it unveiled several significant changes, and the market reactions to those changes revealed that all of those changes were exactly as had been expected. So first, the rate at which the Fed tapers off its asset purchases will indeed be accelerated. So they expect it first to be done in June. Now they expect the job to be done in March. And second, we have a fresh guidance on interest rates. So if you go slightly back to page 16, this is the picture that we showed you 4 weeks ago, the picture of the path of interest rates. So that shows you the rate projections for each FOMC member, so the governors of the Fed, in the future. So you saw last month from this September forecast that the median FOMC participant was forecasting one hike in 2022 and two in 2023, bringing us to 0.75 to 1% in 2023. And it was indeed expected yesterday that they would show a significant rise in hawkishness on that front. And they did, which is what we see on page 17. We're moving from one hike in 2022 and 2 to 3 hikes in 2023 to 3 hikes in 2022 and 3 hikes in 2023. That really is some meaningful escalation. What's very crucial here is our highlighted circle on the right-hand side. Longer run projections for the terminal rate have remained completely unchanged. So to your point, Ron, the Fed's governors still believe indeed that rates will never need to go higher than 2.5% grossly, which is where Fed funds peaked back in 2019. So there is a lot of hope that inflation can be brought down under control with very relative and very modest ease. So quickly on page 18, a picture of the balance sheet of the Fed. The other thing they announced on top of this forecast for rates was the faster taper of their asset purchase program. So what you see here is the very high growth in the Fed's balance sheet. So the government assets mostly and mortgage securities that they've been buying since the crisis started in March 2020. So they had a 120 billion monthly asset purchase program. Today, they are very rapidly stopping this, or rather slowing the pace of this asset purchase program. So what still happens is that every week or every other week, the Fed still goes out there and buys assets. Much less than 2 weeks before, but it still does. So in reality, because the economy is expanding, because there is inflation, that is, as a policy, still more accommodative, not less. However, still expected to be done in March, at which point, and this is the lighter blue dotted line that you see here, at which point the balance sheet is expected to stabilize. So now, Ron, if you will, we will go into the market reactions to this news, unless you have any.
No, I mean, I was
questions?
just going to comment. Yeah, no, I was just going to comment here, and for people that have been a client a while, have heard me talk a lot about the Fed's monetary policy and what this means. Essentially, as the Fed's buying assets in the public markets, they're creating cash, right? This is creating currency essentially, and the pace with which they've the pace with which they've decided to interact in the open market in terms of buying assets and creating cash in the economy is unprecedented, right? So the impact on this, when the Fed announces that they're going to they're going to accelerate the pace of slowing how much they buy every month, right? It's kind of the Fed's double speak. So essentially, instead of buying 120 billion, they're going to start decreasing that by 30 billion. And the less assets theoretically that the Federal Reserve is out there buying in the open market, right, the less demand there is for some asset. and the expectation is that it'll help increase interest rates slightly at a measured pace. If the Fed just stopped buying all assets tomorrow, most economists and market analysts would agree that that would probably have quite a significant jolting effect, like an EpiPen effect, if you would, to the markets, and it would be very disastrous for banks and interest rate sensitive markets and things like this. So by reducing how much new capital they're creating every month, and by reducing the amount of assets that they're buying, what that means is those people that want, those institutions that want to sell, whether it's government securities or mortgage-backed securities, agency-backed securities, et cetera, they're going to have to offer a little bit higher interest rate to the rest of the market buyers, right, to entice them to buy. That's kind of the theory. So just in case anybody's wondering what this means and why the Fed would slow that down, it's they're hoping to have kind of a slow and gradual rise in interest rates that would also help soften the rate of consumer price change, inflation in the economy. Here we go.
Yep,
Reactions.
that's exactly that's exactly the mechanism of those announcements. And you have reactions from the markets. And yesterday was pretty interesting because at first, the announcement, like the communique itself, was a tad more hawkish than what had been expected. So the market responded accordingly at the beginning. That is, equities went slightly down, rates went up, and expected inflation went down. Because higher rates, more control of inflation. And surprisingly enough, or interestingly enough, the critical variable in the market's relaxed reaction that happened after that was really Powell's press conference that started 30 minutes after the announcement. That's really what you see here on this chart. You had a U-turn when he spoke. Expectations for inflation went down at first, and then they rose. They still remain pretty moderate. That needs to be said, but it's interesting to analyze this. And that means that from Chair Powell's tone and wording, the audience felt like he was not going to try too hard and too soon to contain inflation. That's basically what he meant. So if you look at another indicator, equity prices, similarly went down and then went up. And what's interesting here, so you have a white plot is the broad equity market, S&P 500, so big cap, large cap rather. And the blue plot is the more tech side of the market, so NASDAQ 100. What's interesting to observe is that the blue plot is much sharper. So those tech stocks seem to be much more sensitive to rates news. And that makes a lot of sense because those tech companies tend to be growth companies. And as we've become accustomed to saying on this market update webinar, when you're a growth stock, your earnings are farther in the future relatively to non-growth stocks. And so the way Wall Street prices and values companies, discounted cash flows, is such that the sensitivity to rates when you discount the cash flows is much greater for those cash flows that are far into the future. And so it opened down, stayed down after the communique, and then it was brought up by Powell's speech. I think it's very interesting now to really take a step back, move away from these 4 weeks of news and look at the longer trend. On page 23, you have very simple chart, the S&P 500 indexed to 100 in 2012. And you see that we still are on this like one of the major bull markets in recent history. And most surprisingly and interestingly, since the height of the crisis, of the COVID crisis in March 2020, we're up 80%. So one question you might ask yourself and friends around you is why? Like that seems a little counterintuitive. So how amid such a crisis, how under such under so harsh circumstances for businesses can you have such a rise in equity prices? We had very like historical and unprecedented supply shock across the whole OECD economies, and especially for companies. You had a rise in commodity prices. You had a rise in transport costs. You had a rise in semiconductor prices. The two variables that really helped companies go through that crisis and pass with really flying colors and do even better than before is because they had so much pricing power. They could pass all of those rising costs through to customers. So you had consumer inflation, but the margins of businesses, they really were not eaten by the recent macroeconomic developments. Earnings in the last few weeks and few months really spiked. And the second thing, it's always an important variable, is how central bankers react, and they have seldom been throughout history as dovish as they have been over the past 18 months. So bottom line, equity owners were winners of this 18-month crisis now still going on. The question you might ask is, well, if there is a winner, there has to be a loser. So equity owners are definitely winners. Consumers are overall losers. CPI going up, a lot of inflation, and lenders also are losers because rates are lower. So if you happen to be as an individual, you always are both an equity owner and a consumer. But if equities impact more your net worth or your ability to spend, then the changes in consumption prices, well, you're better off today than 2 years ago. One thing that's very interesting to realize and to see is the correlation between what we mentioned a little earlier, the pace of asset purchases at the Fed, which translates into much broader money supply. So here we have M2, which is a measure of the money supply in the US in light blue. From a quick look at those two plots, dark blue is equity valuation. You can really see that there is correlation, there is a link there.
Yeah, and I'll jump in here real quick, Alex. This is something you know that I like to talk about and do a fair amount of thinking on. And one of the questions that always comes up when we're looking at the returns for our clients in their portfolio, right, is obviously an easy one is looking at what might be broadly defined as a real rate of return, right, which would be the change in the value of the account less what inflation would have been by the measure that we're using, right, CPI. Another interesting way to look at it is to actually say, hey, as the Federal Reserve buys assets in the open market, as they create more currency, right, that's actually M0, M2 is an additive to that, and Alex and I won't get too nerdy and talk about the details and the definitions, just kind of broadly know this blue line here is the rate of the increase in currency in the US. And again, it's not perfectly correlated to driving the S&P 500, following that, but there is correlation. So some of the increase in financial asset prices, the S&P 500, is definitely due to the increase in cash that's out there. I was just talking with a client on the phone right before I got on this webinar about the possibility that the S&P 500 in and of itself, the index, might actually be a good proxy when we look at inflation in the economy, right, and or even a hedge against inflation. So what this is representing here is that as the Feds expanded their balance sheet, created more cash, yes, that theoretically in just pure economic terms is not a good thing. It has driven financial asset prices higher, right? So this also is contributing, I believe, to the reason why there is a widening wealth gap in the United States as well. People that have assets invested in the financial market, people that own significant amounts of real estate, have seen a massive expansion in their net worth, right? And in fact, just a quite astounding, multiplication of their net worth. Is that a good thing or a bad thing? That's not for this, but it's definitely had disparate effects across the economy. If you are, in the lower income end of the distribution, the increase in prices, especially around food and diapers and everyday things, has obviously hit you hard. And if you don't have assets invested in the stock market, you haven't participated in this, really rapid upward trajectory in values that might have compensated you for some of that. So this has definitely been benefiting people that have lots of financial assets, have real estate, and possibly even coming at the expense of maybe just the average, we'll say working class American family.
Yes, indeed. There's a there's a saying I very often run across, which says volatility cannot be tamed, cannot fade away, it can only be displaced. I think that really reflects what you just said, Ron. I mean, money printing by the Fed might sound like free lunch to equity owners, but the risk, the volatility really is only being moved to maybe social unrest or any negative thing that that inequality can bring about. And so our very last few slides, very rapidly, are showing you guys how our core equity strategy at Lifeworks, which is diversified premia, has been behaving since we officially launched it in late April this year. So you have here a plot against S&P 500. We are roughly in line, slightly ahead, 14%. S&P is 12.6% up over the same period. Diversified premia is a multi-factor quantitative strategy. It's not for this presentation or this webinar to describe it, but we'll be very happy to give you more details offline. And if you move to the next page, you have this same strategy, the diversified premia index, against similar strategies designed by other fund managers, and the largest of them, that is BlackRock, Vanguard, and Goldman Sachs. So DP, short form for diversified premia, holding pretty well so far. And that's it for our pages today.
Yeah, so for those of you guys that have submitted some questions, Alex and I will try and field some of them here. If you've been watching and you have a few things that you'd like us to go back on the slides, or even just something that popped up and you'd like either Alex or myself to maybe speak into it a little bit, we're happy to do that. We're going to keep the live feed open for probably another 10-15 minutes. So again, if you're on the video screen, there should be a little pop-up box where you can submit a question. They get put up on a monitor right here in front of myself and then in front of Alex as well. Alex, as we think about 2021, right? Hindsight's always 2020, but while we're maybe waiting for Skylar to throw a couple of the questions up there, take me back through a couple of things that you maybe found most interesting this year in terms of either the news and its impact to the markets or lack thereof, or maybe just something that you took away from this year as the head of our investment strategy and as an investor yourself.
Yeah, I mean, most definitely, most definitely central banking. I would say two things. One is central banking. Very rarely before, or maybe never, had we talked this much about central banking. I mean, I'm not old enough to remember but when I look at newspapers, and very recently I looked at an analysis around this, tapering, money printing, money supply, all of these are technical terms that have almost become widely used by mainstream newspapers and mainstream media, which is very I'm not judging the decisions by the Fed, for example, or the ECB in Europe, but that has one benefit, which is to make people very much interested about the economy overall, and also they were interested because they were impacted like never before, especially by inflation. So this was the first thing that had my attention this year, and the second thing is very much related to this, and that's around the same idea of people and almost everyone getting back to subjects and getting back to studying things as citizens, as individuals, that they were not supposed to be talking about again. And that is what is money? What does trust have to do with money? And the cryptocurrency debates that everyone has been having for a year or 2 years now really like to me or something special. Whether you are a crypto enthusiast or a minimalist, at least you're sitting down with your friends or you're reading some stuff online, and you discover again that money is basically a social construct that is extremely interesting.
Yeah, and it's great that you brought that up. This is a question we get a lot. Somebody posted this one on here. They asked what we thought about cryptocurrencies and/or if we were going to be including, more exposure to them in our portfolios going forward. That's a loaded question. We won't have time to get into, maybe kind of the future impacts of it. But let's just take a couple minutes here because we have some time. And this is a question we get a lot, and somebody posted it here for us. Talk to us a little bit about cryptocurrency as an asset. So let's just use Bitcoin as a proxy. Is it an asset or is it currency, right? How should we be thinking about potentially owning it or having exposure to it in our portfolio? We'll maybe pick those two because that probably takes it to the depth of whoever this was that asked the question about that.
Yeah, really quickly before I take those two, I think very important to make a difference between two types of cryptocurrencies. On the one hand, you have it's called private crypto. That's the case of Bitcoin you're asking about. On the other end, you have a central bank digital currency, CBDC. Those are very separate things. On the one hand, you just have a new form of dollars, like your dollars are directly connected to the central bank. On the other hand, you have private citizens launching sometimes very interesting, sometimes very risky private projects using a new technology, the blockchain. So on your question on Bitcoin, we are as an RIA, we are already giving some exposure to Bitcoin. If you are a client of ours already, you know how we allocate risk to clients between different tranches. We have one tactical tranche where there is a small but still substantial allocation to Bitcoin. To the question whether Bitcoin is an asset or a currency, if you go back to the original white paper written 13 years ago now by Mr. Nakamoto, Satoshi, Bitcoin really was supposed to be a currency. It was first used to buy pizza, and it is indeed
the famous
used
transaction.
today. Yeah, that famous transaction. It is still used today by some people to transact. However, 99% of the quote-unquote market cap of Bitcoin is in the hands of people that use it to speculate, to get diversified exposure. In that sense, it's a speculative asset.
Yeah, and that's and thanks for sharing that. I think that's kind of the conversation we have a lot with clients on a one-to-one basis, and I know our advisors are fielding lots of questions about it. As a general statement, we definitely think there's something there. There are literally thousands, Alex didn't allude to the number, but there are literally thousands of private blockchain type of projects, currencies, NFTs, et cetera, that are out there. A lot of them are highly speculative. A lot of them just absolutely blow up in grand fashion. But if you're talking about Bitcoin or Ethereum as just kind of a proxy for that market, there's definitely something there, and clearly the technology that's behind it is like Pandora's box that's been opened. I think the markets And different industries across the world are going to be thinking about ways to use this to improve ownership, to reduce costs, to think about transporting value, things like that. So it's a good one. Another question that comes up is that popped up. Somebody asked about our protected portfolio, our hedging strategies, right? We know from all of the graphs today, inflation's running really hot, which means if we were sitting in lots of cash or lots of fixed income, they would definitely be, losers this year, right? It'd be a tough year to have a large, allocation to cash or a bond portfolio. Talk to us a little about, the thinking around holding, the diversified Premia, our basket of 50 equities using our factor strategy, and then hedging going forward. What are some of the things that our team's been talking about, and you've been leading those conversations, Alex, as it's kind of like looking forward to next year?
Definitely. So the first reason we handle things this way, you've already alluded to, is the realization that bonds going forward in the very near future do not or are not expected to bring the so-called diversification benefits that they used to provide. And so we were looking for an alternative and a more reliable way to provide a truly diversified portfolio to investors, and not only give them a growth exposure, but also protect them. And so the asset that, in our opinion, was serving that purpose best was put options. Mm-hmm. So we start from this diversified Premia equity strategy, 50 stocks, and we wrap up, depending on your dollar exposure to those 50 stocks, depending on the size of your portfolio, depending also on the sensitivity in real time of those 50 stocks to the broad equity market. We wrap up a certain quantity of put options on an equity index, which is like the SPY ETF. Mm-hmm. In that setting, you get growth exposure, so what we call upside participation, and downside protection in a convex way. That is, the more the market goes down, if it does, the stronger your protection.
Awesome. Probably final question we have time for, and then we'll be wrapping up here. And for anybody watching, if you think about a question later today, and the video recording of this presentation will be sent out sometime later today along with the slides. If you're going through that, over the next couple of days, week, and you have a question, don't hesitate to send them to your advisor or to, send them in to Alex. We love getting questions. We love hopping on video calls and chatting about this stuff with you guys. It's part of our passion and what we do. Last question, and we'll wrap up. There's lots of talk this year in news and back and forth, and I don't want to get into politics per se, but I have a very specific question about the impact to, or the potential impact to equity prices if there was a significant change in tax law. So the current administration and the Democrats have been, pushing through, this Build Back, Better bill and some different tax legislation. Nothing's passed as of yet, but they have talked about raising income taxes on individuals and corporations. I want to zero in on your opinion, Alex, and your take on the impact to equity prices if corporate taxes were raised. I have a theory that I would be working on, but I'd love to hear your thoughts. That was kind of the question: is what might be the impact to the equity markets if there was a, I can't say a significant increase in corporate taxes, let's just say some type of meaningful increase to business tax rates. What are your thoughts there?
I'd be happy to hear your theory afterwards. But my quick
okay,
answer
I'll give mine after you give yours.
Awesome. So the quick answer to this is the way equities are being valued by the market is this so-called discounted cash flow. So you're trying to estimate how much profits companies are going to make in the future. And by profits, we mean net profits. So everything else equal, if you raise the tax rate, you get lower net profits, which is a negative impact to valuations. That is, again, everything else equal, because if those extra dollars received by the government gets invested in a way that buoys and supports the economy, you could have another positive effect to counterbalance it. But that's my quick take.
Yeah, mine would generally be that I don't believe corporations pay taxes. I believe they just adjust their pricing of their goods and services they're creating to the extent they can to still target, their financial objectives that they have for the corporation. So raise tax on the corporations, they're probably going to raise prices to the extent they can. So I'll use your phrase, all else equal. So I find it interesting when I see, the PPI, and we didn't have on here like the ISM index where we're looking at kind of more of the industrial side of it. Maybe next time we talk, let's throw that in there and kind of look at that too. But when you have, pretty high spike in, finished goods, the producer price index, it would be a really interesting time to potentially see taxes go up, because we might actually see what Alex just described there truly play out, which is corporations that are at all-time high profit margins right now see a deterioration in their profit margins because they've been raising prices throughout this pandemic. And they obviously can't do that indefinitely. There will be a limit on, how much they can increase the price of goods before people stop buying less and less of them. So my take isn't necessarily that different than yours, but maybe a little bit more to the position that corporations really don't pay taxes. They just pass that through as a cost to you and I and everybody watching. That's the end user. So awesome discussion. Alex, thanks for putting this slide deck together. Very informative. I know it took you and your team many, many hours of doing that and getting to watch all of the FOMC meeting minutes and Powell's talk is, maybe not the most scintillating for most of us. So thanks for digesting that and passing that along. And for those of you watching that are clients of Lifeworks, we are always grateful and humbled to get to serve you and your families. We hope you found this to be informative. Again, reach out to your advisor, have them schedule a time with Alex or anybody on our investment team to potentially go deeper on any of the topics about our investment strategies, how they pertain to you. And we wish you and your families a Merry Christmas and a Happy New Year. Have a great holidays ahead. Be safe in your travels. And we look forward to seeing you guys on another live Lifeworks webinar in the future. Alex, thank you very much, and take care of yourself.
And you, and Happy New Year, everyone. Thank you.